Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's Annuity Agent, licensed in all 50 states. This is a big one today. The podcast is about the banking crisis. It's about annuity companies. I've been inundated with people saying, "Hey, Stan, you need to cover this. You need to come to worry. Don't you need to cover this?" So I bring in the top talent, Mr. John Lenz. I call him the annuity architect, but he's so much more than that. I mean, he's forgotten more than most people in the annuity world have ever he's forgotten more than they ever learned. That was the line I was looking for. But he's a good friend, but he's also very well versed in this and actually did some research and studying and spent time and all this stuff instead of just watching CNBC. So, the disclaimer a little bit is, we're not going to mention carrier names and we're not selling annuities today. What we are trying to do is answer some of the common questions that are out there and some of the fears. And we're going to provide you with the facts to the best of our knowledge. So with that being said, John Lenz, welcome to Fun with Annuities, man.
Thanks for having me. It's good to be back.
John, I've heard a really interesting rumor about banks recently having some issues. Have you heard the same thing?
I have seen a couple of things in the news that there's some banks seem to be making the news lately. Yes.
Yes, they have.
Yeah, indeed. It's not 08, 09, and 2010 all over again, but it is definitely a little scary that 800 days or more have gone by since there was a bank failure in the United States. And now there's been 4 in the past not too long, and a few more that are scrambling right now.
And we're not going to try to predict the future. I mean, we're not going to sit and go, well, we really think this. I mean, I saw something the other day. One of the guys from Shark Tank, I forgot who it is. It's the guy that is follically challenged.
Mr. Wonderful.
Mr. Wonderful.
He and I
Mr. Wonderful said that he doesn't see, he doesn't see the survival of regional banks. There'll be no regional banks, and he's comparing what's going to happen to us in the future with Canada, who doesn't have regional banks. And then Mr. Good Dad, Bad Dad, you're a dad, I'm a dad, we're all a dad, Kiyosaki comes out and just gloom and doomed as well, which, forces people to call me and forces people to call you, which leads to this podcast. Who knows if they're right? They don't know if they're right. But let's talk about banks first and the fact that all of this kind of happened. All of this was kind of a cascading domino effect. For a second, let me go through it real quick. This is the way I understand it, John. So this is my English version of it, my Southern version of it. COVID happened. You remember that. COVID happened. People couldn't go to work, so we printed money. We sent people money so they wouldn't work. When we sent money and we printed money, it created inflation. Because inflation was created, then the Fed has to raise rates to try to quell inflation. So when they did that, banks, because they're holding bonds, there's a correlation between prices and interest rates. When interest rates go up, bond prices go down. So the bonds that were held by the banks went down, and to cover whatever formula the banks have for reserves, et cetera, requirements, they had to sell those bonds, which created somewhat of a panic because we live in a 24/7 social media world, which created a run on the banks, which created confidence issues. And now me and you are here on the podcast. Is that a good Southern version of what happened?
I think that is. Yeah. When these banks, and again, I know we're not trying to talk about names, and Stan and I have a bet about if the name of the bank will slip out or not.
No, it's not.
Not that it's not public knowledge of who they are. We hope to say only what's true, but right. This bank had large deposits.
Sure.
They bought 10-year bonds to back these deposits. And then when the Fed raised short-term rates and inflation came out, the value of those 10-year notes dropped significantly And then people wanted their money out. And in order to sell them, I read $1.8 billion loss. And that creates a cascading effect. I think you said it well. This was a Twitter-fed bank failure where people want to draw their money out. Of course, that money's lent out. It's not readily available.
Correct.
And then another one failed. And yeah, but the good news is that the federal government has truly stepped in and come to the day and rescued us in the short term. And that's an argument, right? Whether you fix this now or postpone the problem till later. And that was an 08, 09 argument as well.
Yeah, and there's been some shotgun weddings. There was 2 Swiss banks that were forced to marry. One of them I used to work for a long time ago, and I know for a fact that that was not amicable. That was almost forced, similar to 2008 when they put all the big banks in the room and said, you know, here's what we want you to do. And some banks said, yeah, I don't want to do that. And they said, no, let me rephrase it. Here's what you're going to do.
Right.
Okay. And the same thing happened with the Swiss banks. I think my concern here and what's triggering a lot of this with my clients and my listeners is when Miss Yellen at the time of this taping, head of the Treasury, is saying, yes, we will guarantee deposits over the FDIC level, and then comes back later and says, yeah, but not for all banks. Now it gets weird, possibly political. What was your take when she said that?
Yeah, I don't know what to think about that either. The first blush at the big bank that was failing down in Silicon Valley was, we're going to step in and insure all depositors, not the bank equity holders, not the stockholders, the shareholders, the bondholders of the bank, but the depositors in the bank, even though they were over the $250,000 FDIC limit, were going to be insured. And that was just basically to instill confidence in the banking system. I mean, our monetary system is truly based on confidence. If I give you $100 for some reason, it's so you'll take that money and give me something knowing you can trade that $100 for something of value, even though it's not backed by gold or platinum or silver. So the Feds, in my view, the Feds stepping up saying, yep, we got this. And I think Warren Buffett said it really well a couple of days ago. He said, we live in a society that where the government is supporting the banking system as we are too big to fail. So the government has shown its willingness to step up and support the banks. And then today, Janet Yellen said, today is what, the 20-something?
Yeah, at the time this will come out a week from the time we're taping. So yes.
So yeah, a lot of things will have changed between now and then. But Janet Yellen came out in support of regional banks, contrary to Mr. Wonderful's statement. And again, who knows? But it's all about confidence, and the market seemed to rally. Bank stocks rallied today. The one bank that seems to be in a little bit of trouble, that had a $30 billion bailout from sister banks, rallied today. So I'm fairly optimistic and hopeful. But yes, people are worried. I personally don't have $250,000 of cash in any one bank for that exact reason. And I don't have a lot of $250,000 deposits anywhere, just for the record.
Before we get into the details and the weeds, my take on this from the Southern version, and people love my Southernisms because that's kind of the way I think. You know, annuity companies are buying similar bonds. I think the difference is with the rules, and correct me if I'm wrong, this is where you're going to step in and be who you are. But the difference is the banks have to sell them based upon a formula they have to reach. The annuity companies, there's no one at the window. They really don't have to sell. Is that correct?
Yeah, I'd say that's correct in large part. The annuity companies reserve for an annuity very differently than a bank. And if you want to go into that,
explain that. Yeah,
I think it's an excellent time to do it.
Let's dig. Yeah.
So this goes back 40 years or more, when the insurance industry, led by the National Association of Insurance Commissioners, wanted to make sure.
Let's stop there for a second. Every state has an insurance commissioner. State insurance commissioner. This is the National Association where they make the overall decisions for the industry, for the country, but fixed annuities are issued and approved at the state level. Variable annuities are securities. Okay,
Yep.
so
So
with that being said, so let's go with the NAIC.
Yep. So the NAIC has an actuarial team, and their goal is to provide stability and strength inside the insurance industry. Because talk about confidence. I mean, if you heard that XYZ company wasn't paying if your house burnt down, you wouldn't be buying fire insurance from that company. So the NAIC's job is to make sure that insurance companies remain solvent. So they built formulas that were originally based on life insurance ongoing premiums that have evolved from these factor-based methodologies into principle-based methodologies.
Right.
So I'll give you a good example. Let's say you send $100,000 of annuity money to an insurance company. And that insurance company now has to go out and invest that money. And there is a reserve that is established by a formula where the insurance company now has a liability to the annuity owner of $100,000. And so they have to purchase an asset for $100,000 and then add some capital over and above that to provide a safety net and a cushion.
Right.
So that's called a required capital level.
Right.
And then we have insurance companies that are now adding multiples of that. So a typical insurance company might have 300, 400% of the required capital. And that is a cushion in case bonds default, interest rates go up, other risks. There's a whole series of contingency plans, C0 through C4. And it is super complicated. And I don't even pretend to understand it all. But I just know that insurance companies are daily looking at what would happen if interest rates rose and a certain number of people left or died or annuitized their policies or took RMDs.
So they're running stress tests
all the time.
All the time. Whereas we hear banks, let's run stress tests on the banks, and maybe they are running them, maybe they aren't. I think one of the arguments with the banks in question here is that they weren't running the stress test. And another Southernism I always use is I say, and this might be incorrect, and if so, step in and detail me. But I say, annuity companies, life insurance companies that issue annuities are not smarter than banks. They're more regulated and handcuffed than banks. I think you just kind of laid that out. The reserve requirements in place that the NAIC has put in place, they're pretty stringent and rigid. They can't be that flexible, in my opinion. Am I right?
Yeah, the insurance industry has to take this money that they owe the annuity policy owner. That's a liability. They buy an asset or basket of assets to support it, typically investment grade bonds, mortgages, and they take those assets and they put them out there as an offset against the liability. And then they increase that number by a margin so that there's a safety net. And if bonds in this portfolio drop in value, there are new metrics that are run and additional capital has to be added to that. And there is ongoing reporting to the states. It's super regulated.
It is very capitalized. And I'm not saying that, annuity companies are smarter or better, or you should choose annuities over CDs and banks and all that stuff. I'm not saying that at all. What I'm saying is the handcuffs, the loving regulatory handcuffs that's been put in place prevents annuity companies from being really, really stupid. How's that Southernism?
I don't know if I'm going to go on the record as saying insurance companies are or aren't really, really stupid, but I don't really think they are.
No, I understand, but you know where I'm headed.
Well, what I hear from insurance companies is they're super conservative, heavily regulated. And one of my closest friends in the world is an actuary at a local company. And he and I have had many, many discussions about these reserves and reinsurance agreements and what happens if an insurance company were to take, say, a high yield security on a lower, a quality debt instrument and use that as an asset.
Right.
Well, this model says, oh, that's not a class 1 or a class 2 security. It's a 3, 4, or a 5.
Right.
Therefore, you've got to put additional capital aside to back that asset. So there's layers of redundancy to try to keep insurance companies healthy. And it really works. If you look at the number of banks that failed in the 08, 09 and bled to 2010, there are 500-ish banks that failed during that period. A relatively small number of insurance companies, literally 1/20th the number. In fact, the last 6 insurance company failures were all hurricane related back in where you're from. Small companies that got
these are
too much
property
wind.
and casualty. I always say P&C companies, property and casualty companies, go out of business because they don't know when the hurricane's going to hit. Life insurance companies that just sell life insurance, they have the big buildings and the logo on the plane because they know when we're going to die. That is absolutely true. Living in Florida on the beach, we see these companies come and go, and every 2 years we're having to change insurance companies for flood or whatever. For that reason, you live on the coast of Oregon, same thing. It's you mentioned something to me the other day about risk-based capital regulators and all that stuff. Can you go into that even more than where you've been right now?
Yeah, and I'm sure I'll say something that's just completely laughable before it's over. But at the end of the day, this capital that has to be set aside, the surplus, the extra cushion, is based on the risk class of the assets that are backing the annuity liability. And so the insurance companies literally have to grade their assets under this NAIC rule book. And if they have real estate, it's a certain multiplier. If it's a high quality bond like a U.S. Treasury, that's the very best of all debt.
Sure.
And if that debt gets upgraded or downgraded, they've got to review that and then add capital. So this is going on literally all the time. And insurance companies have to report to the states. And then there's a head actuary at the insurance company that has to report to the board of directors, I believe annually. Here's our position.
Right.
And it's really closely watched. So every one of these assets that they buy is categorized and then factored so that the adequate amount of capital is there to make sure the annuity policyholder is protected. There's one other thing that's worth talking about there too, is that the insurance company has mechanisms built into their annuity contract to keep the customer there in these volatile times.
Correct.
So it's typically a market value adjustment or a surrender penalty if you leave early. We see
so
those.
let's go over market value adjustment and do it in the quick and easy. Explain it to a 9-year-old. No offense to 9-year-old version. Market value adjustment. You buy the annuity. The interest rates go up after you buy it. What does the market value adjustment do?
So if interest rates go up after you purchase your annuity, then the bonds that are backing that annuity drop in value. And that's what caused the big run on the bank in Silicon Valley. So at most insurance companies, they add a feature called a market value adjustment, which penalizes a client from wanting to liquidate their annuity in that environment. So that helps protect these capital ratios.
Right.
As the liability to the policyholder goes down, so along with the insurance company's capital. Then when interest rates recover or they get to the end of the annuity 5-year, 7-year, 10-year, 3-year term, then everything comes back to a point.
So bottom line, they buy the annuity, interest rates go up after they buy it. They want to surrender the penalty. Will market value adjustments lower that surrender charge or raise that surrender
charge? It would
charge?
increase the surrender charge, keeping the client there, avoiding the run on the bank. So what happened at this big bank that failed is people went in, took out huge deposits, and the bank's investments were underwater, and they just literally didn't have the money. So at the insurance company, when you do someone purchases an annuity, the insurance company's got to go out and invest that money, 5 to 10 years, sometimes longer.
Sure.
And if you want to leave 1 year later, the insurance company has to break their deal with their investment, which could mean suffering a loss. So that's transmitted over to the customer, which eventually strengthens the insurance company's balance sheet.
Exactly. So let's go backwards again. Let's do this so the listener and viewer, which by the way, thank you. All people listen to us on all major podcast platforms and the Fun with Annuities YouTube channel. So you buy an annuity, interest rates go up after you buy it, your surrender charge will increase, but look at that as a good thing because it's really helping the companies not to prevent a run. Now reverse that, you buy an annuity and interest rates go down drastically after you purchase it, then the market value adjustment is going to lower the surrender charges. And me and you have both seen it work in the consumer's favor, where they literally can kind of get out without penalty. But the reason that these two levers are in place, market value adjustment, MVA, okay, you'll see that like on my MIGA feed, you'll see MVA. Okay, the reason MVA is there and surrender charges are there is two tools to prevent what happened with the banks. Am I correct about that?
Agreed. Yes, that is a big contributor to keeping those deposits safe at the insurance company, because everybody's interests are served if the insurance company remains solvent, because that's where your deposit is. I mean, they're insuring your money. They want everybody wants to have solvency, and so those two things, the market value adjustment and the surrender penalty, help protect the insurance company and its policyholders. Now, as you know, you can buy an annuity without a market value adjustment that guarantees a refund 100% of your deposit at any time. If you do that, you usually give up some interest rate, because the insurance company now has additional capital requirements because they have got to reserve more heavily for that policy. And then as the policy comes closer to its maturity date, then the insurance company's reserves have to reflect the fact that it could be fully liquid.
Which is the Southernism of annuity companies will give you what you want. They just won't give it away. I mean, they really won't. They're going to price it in and hedge the risk as you're describing. But for the person out there that's kind of running it in their head, you know, I'm not sure you can make a direct correlation to what's happening with the banks and with life insurance companies issuing annuities, but let's try to.
No, I'll make one that's very straightforward. If we look at the issue down in California with the big bank, the depositors could withdraw their money allegedly at any time and did attempt to, but the bank had gone out and bought 10-year treasuries.
Right.
Those notes had declined in value, some of them as much as 15 or 20%. So now the bank doesn't have enough capital to take care of that problem. So they did what I would consider a mismatch of asset liabilities. They had a liability that was liquid, and they purchased an asset that was illiquid. Insurance companies can't do that. They have to do this asset liability matching, where if they've got a 5-year surrender penalty on the annuity, then they need to have a basket of assets that's going to be maturing in 5 years so that they can be fully liquid and distribute to the customer. Now, the insurance companies are also able to use formulas, knowing that not everybody's going to leave all at the same time. But if your policy is with an insurance company and it's fully liquid and can leave at any time, it's probably going to have a relatively low interest rate because it can leave at any time. And obviously, you know, people do move around. One other safeguard that I think is really relevant here is it was reported in the press that some of the not policyholders, the account holders at some of these big banks that have had trouble were withdrawing millions of dollars, tens of millions of dollars, $50 million.
Right.
That isn't going to happen at an insurance company because, as you know, when one of your fans calls up and says, Stan, I want to do a $2 million annuity, you've got to say, you know, most of our companies want to do $1 million maximum.
I was just going to bring that up.
Yeah, we never have somebody coming on, say, I want my 100 million out now. And that's purposeful by the insurance company. They don't want to have that big disintermediation risk. So they limit it, you know, average annuity size just over $100,000. So if somebody calls up and wants their money, it's no big deal, because the insurance companies are buying securities that are liquid, they're marketable, saleable in the bond market and the mortgage market. So yeah, it's a much more, I should say, regulated, very heavily capitalized business.
Absolutely. And a lot of the big clients that I have will say, well, I want to put, you know, multiple millions into one carrier. And I'm saying they're not going to take it. And they're like, they won't take my money. No. If you go to my MIGA feed, you'll see, you know, some companies will allow you to put up to $1 million or up to $3 million, but there are limitations. Some of them will say just up to 500,000. They're trying, what they're doing is they know how they can guarantee the contractual interest rate to you, but they also know how much money they need to bring in. And once they bring that in, as we call capacity, then they'll ratchet down those guarantees. Whereas a bank, it's some, I don't want to use the word free for all, but I can't come up with a better word other than there aren't those limitations. The only limitations are consumer driven, knowing FDIC limits or SIPC, that's the securities industry limits, and going up into that limit, but that's voluntary to the consumer.
Yeah, I really don't know much about bank reserves. I spent quite a bit of time with people in the insurance industry talking about reserves and risk-based capital and the requirements.
Mm-hmm.
And I own annuities, as I know you do.
Yep.
And I feel very comfortable today with those annuity contracts. I guess the other thing we didn't really talk about yet was that, you know, annuities, as you know, are not FDIC insured.
No, they're not.
But each state has, and most of them follow the NAIC Model Act for a state guarantee fund that
Let's stop for a
covers.
second. Let me give you that website for the listeners and viewers. That is NOLHGA.com. NOLHGA.com if you want to go and look yourself, employer state. And I would encourage you to, if you really want to dig in, just go to the FAQs, frequently asked questions, and right there you're going to see coverage and the rules, and some of it it's hard to decipher. But I think one thing to point out before we go back into the state guarantee funds is you cannot use a state guarantee fund guarantee as part of a sales presentation. Okay.
Right.
Meaning that the industry really wants you to base your decision on the claims paying ability of the carrier. So let's go back to the state guarantee fund.
So the state guarantee fund was an attempt by the insurance industry to create, again, additional layer of security for the policyholder. So if there is some unusual catastrophic event, you have an insurance company, their capital ratio drops to the point where they no longer have 100% of the required this excess capital and surplus, and they still have their underlying investments backing it, but now they don't have the extra layer, it's not thick enough. Mm-hmm. Then the insurance commissioner of that state can order that into a rehabilitation and try to strengthen the company. So in the event that there is a failure, which would be where a company, let's say, had $1 billion that they owed and they had less than $1 billion in the kitty, mm-hmm. then the state insurance pools, guarantee associations will pick up the up to $250,000 of annuities, and these are again fixed and index annuities. And
in some states are higher, some states.
Yeah, that's a good point.
Yeah, I mean,
yeah, there's a few states that are different.
Yeah, they're all different. So go and go to NOLHGA.com, go to FAQs, pull up your state, and you'll see it. But again, I tell people all the time, please do not correlate state guarantee funds with FDIC, please. F means federal. F means they can freaking tax us and confiscate the money to come up with it, or print it, which might be where we're headed with this. I know that you've got your ear to the ground of the annuity industry. What are the whispers, without mentioning names and companies? What are you hearing out here during this time period in the annuity industry?
Well, this has been the past 6 months, the craziest time, maybe since the 08-09 mortgage meltdown ever. As you know, you cannot even keep up with your inbound email and phone calls, and neither can we. This interest rate environment where the 10-year Treasury is, been up over 4 for a little bit and closer to 350 today, has pushed annuities into that 3 to 5 to 7 to 10-year space at 5 and better.
Yep.
And that has created a tremendous opportunity for people to lock in a competitive interest rate that's guaranteed and safe and tax deferred. So companies are just gulping down the business, and it's created tremendous strain on the insurance company's workforce. Now, as you mentioned COVID earlier, people went remote. That turns out to be a little less efficient. A lot of people quit working, and companies were busy anyway. Well, now all of a sudden they're getting 2, 3, 4, 5 times as much business in the door in any given day. They literally can't process it. We've seen really great companies with high ratings be weeks or sometimes even months behind
Right.
processing and issuing the business.
Right.
And there's a lot of transferring of money going on. I mean, it's not like anybody creates any money themselves on a given day other than what they earn, right? But there's a 100 grand moving from company A to company B, and from a bank to an insurance company to brokerage, and et cetera. So super busy time for insurance companies, and a healthy time in that they're able to purchase these assets that have a good yield on them. And it's definitely going to be good news, I think, long term for the life insurance industry.
Tell me what you think what are the internal reactions to this type of banking news? Because for the people out there that correlate banks and insurance companies and brokerage firms, they're all in one category. They're really not, but they, in their minds, there are. What's the annuity industry? Do you think there'll be changes to either how they communicate the safety of these companies, or do you think there'll be even more requirements to be safe? Because in essence, as I tell everybody, annuities, all different types, they're confidence products. And, we're finding out that banks are confidence products as well. And if people lose confidence, then it's game over. And that's the reason I think the regional banks right now are having a hard time for that. But do you see changes, whether announced or unannounced, happening? Do you predict that?
I'm not sure, other than I'm confident in the process that it's always being revisited, and with an eye to creating additional safety and regulation. But it's a combination of regulation at the state level, where insurance companies are regulated, and the industry's own desire to remain super strong and have this reputation that, yeah, my money is safe there. The industry cannot lose that, or all is lost.
Yeah.
And so there's definitely a feeling of brotherhood and sisterhood in the insurance industry, that everyone wants to see everybody strong. Yeah, I talk, again, the actuarial friends I talk to, they are constantly doing stress tests. What if rates go up again?
Right.
That sort of thing. And of course, we just went through COVID, where life insurance companies had a tremendous amount of excess death during the last couple of years, certainly 1 million extra deaths. And a lot of those people were insured. So those kinds of, that was an unexpected event, right?
Sure.
Not that pandemic is a new word, but it tested the insurance company. Other issues that I see insurance companies dealing with are issues of pricing. Long-term care insurance comes to mind, where the insurance industry priced long-term care, assuming they'd get a certain return on their investments. And of course, rates went down, and they assumed a certain number of policies would lapse. The lapse ratio was far less. And so long-term care prices have had to go way up. And one company failed in all of that, and it's being run by the National Association of Insurance Commissioners, and claims are being, premiums are being paid there, claims are being paid out. So this system has had some failures in the past 40 years. All of them are being managed, and it seems pretty healthy to me.
Yeah, I think that the foundation in place with life insurance companies that issue annuities is very, very strong. And I would think something like this is going to make it even stronger, because there's a call for transparency. The reason we're doing this podcast is I get inundated with hundreds of emails and calls and saying, when are you going to address this? When are you going to do a video on this? When are you going to do a podcast on this? Because they want to know what the real situation is, both good and bad. Let's maybe try to talk about some bad with annuity. I mean, annuity companies, life insurance companies, nobody's perfect. What's the exposure here in your mind with life insurance companies and annuities? Because we can't just sit here and be, because I'm not a homer.
Yeah. No,
I mean, what do you think?
A bad pandemic, one that killed a lot more people than SARS-CoV-2 did. I mean, that's something that it certainly has happened historically throughout the history of the planet. That could happen again. And so the industry, again, if you buy $1 million life insurance policy from somebody, some insurance company, it's likely that 900,000, 90% of that million has been reinsured with other insurance companies, so that we don't have catastrophic losses in one spot. What else could happen? Runaway inflation, really spiking interest rates. Fed steps in, can't stop it.
Like
Really
15%
high.
interest rate, 12 is just gets
Bonds
up.
drop in value. Those
Yes.
sorts of things are, again, they are being stress tested every day. I suppose there's always a fraud issue where something happens, an economic calamity where the bonds that the insurance companies hold default at
So
a
something
larger
really,
risk.
really drastic. As I always say, if it gets that drastic, we're in the grocery store fighting for bread, and it's not the good bread, it's the cheap, bunny bread, stuff, which is good with a tomato sandwich, but that's a whole nother story.
Yeah, well, I did get asked a question like that. Sorry to interrupt. Someone asked me, what if a meteorite hit the planet and everyone died? Well, are you worried about getting paid on that day?
Yeah. Let me call the annuity company for you. You said a word, and I don't know if it's in this category, but I want to address it since I have the brains on the line. Reinsurance. Can you explain to the people listening and viewing reinsurance, how annuity companies go do that, and why they do that, and if that could be an issue with what's happening?
Yeah, reinsurance is a bit of a complicated transaction where an insurance company will take part of their liabilities and transfer those to another company. This happens routinely. Blocks of annuities are sold. There was a $30 billion block of annuity business recently sold from a household name to another a few years ago when a big company took all their annuity business and turned it into an IPO that became a publicly traded company. I guess the most important thing is that the company that issues the policy is still on the hook, even if they reinsure it. At the end of the day, if ABC company issued your policy, they may reinsure it, but the claim's got to be paid by that company. So I guess that's another risk, is there's a reinsurance problem at some point. I mean, life is full of uncertainties, right? I mean, there's only so much that you can do. But yes, reinsurance, the concept is to take some of your liabilities and spread that risk so that you're just bigger than you look.
So to quote a great movie that we all love, Dumb and Dumber, it's like triple stamping and double stamp, whatever that means.
Yeah, I think of it as seat belt and suspenders.
Belt and suspenders, baby. Yeah, just making sure the pants don't fall down. Do you believe in the annuity? I coined a phrase called the annuity mafia. And the annuity mafia is what I call the big companies overseeing the small companies, so the golden goose of confidence will not go away. We've seen that kind of come into play in recent times where companies were absorbed by smaller, lower rated companies, absorbed by the state guarantee fund and the state, and then companies coming in and swooping in, buying up all the guarantees so that, the little old lady, my mother, is not going to, get on the news and go, they took all my money. I mean, that's the last thing they want. Do you believe that is kind of, you talked about it in a brotherhood and sisterhood way. I like annuity mafia because it just, the connotations are better. But do you believe that's in place, especially in these times?
Sure. Yeah, I think that we see that in the banking space. What went on in Switzerland, as you know, two fierce competitors, and one now owns the other. And that's, again, helping restore confidence in the overall system that we will take care of each other. And yeah, there's definitely, before an annuity company went completely upside down and didn't pay claims out, there'd certainly be some efforts to try to absorb that business. And that's happened over and over and over. I mean, those of you out there that have owned an annuity for 10 or 20 or 30 years have probably seen the name change on it a couple of times. Exactly. But what you haven't seen is the underlying guarantees change.
And I think that's good. With clients and people out there looking at annuities, and they're finally figuring out that the word annuity is not all encompassing. There's many different types. People still seem to gravitate towards splitting annuity purchases underneath that state guarantee fund level.
Agreed. Yeah.
I tell people all the time, that's fine. Listen to your gut feeling instinct, because that's what it's your money, and I respect that. But with some of the big AA+ carriers, we're not going to mention names, A+ whatever, Do you think that's being belts and suspenders, or do you just think, hey, it's okay if you want to split it up? What's your thought on that?
Each his own.
Got
If
it.
today the strongest A double plus triple A type insurance
Mhm.
companies don't have to pay the highest rate to get the business in the door. It's the
Correct.
lower rated companies that have to put out a little more interest to collect the premium.
Yep.
And there's an argument about whether that, brings more risk on or not. I mean, that's not really a good topic for today, probably, but yeah, whether or not you'd put, let's say, you get 1 million, you put all of that with the biggest, baddest insurance company on the planet, or
Mhm.
you'd spread it out amongst 4 smaller companies in $250,000 chunks. Which one of those is more secure? Because 4 of them would have full state guarantee coverage, and one of them would be covered by somebody that could buy most states. So it's a really good question. And remember, the FDIC and the insurance guarantee associations are for these non-systemic, isolated problem
Sure.
children. If all the banks in the world fail and all the insurance companies fail, then you're right. We're fighting for the leftover bread, and no insurance company and no bank has enough money to protect 100% of everything. Right? I mean, imagine if your car insurance company had to have the full value of everything they insured in cash in there. It's just not enough money.
Explain tail risk with annuities.
Tail risk?
Yeah. You
Uh,
familiar with that?
no, I'm not sure I understand your question.
Well, the tail risk to me is income riders attached to variables or indexed annuities, and that money growing at a monopoly money type level, and it can only be used for income.
Sure.
The
Yeah, no,
way
I understand that.
Okay, so tail risk with that, if everyone turned on the income rider, those type of, I think those are the type of questions that are going to start popping up that the industry is going to need to answer. We're just
Yeah,
going to answer it for them.
I think of that as longevity risk,
Yeah,
where I've heard it described your way. When I think of tail risk, I think of professional errors and omissions risk when you're out of your
correct,
practice. But
correct.
yeah, insurance companies in the earliest annuities, they were payments that stretched out over a period of years or for your lifetime.
Sure.
So there's this risk that people are going to live longer and collect more money. And so some of the features, these riders that were developed first on variable annuities and now heavily on indexed annuities,
Mm-hmm.
provide a lifetime guaranteed withdrawal benefit.
Mm-hmm.
And that there's a question, does that pose a risk to the insurance company? Well, the insurance companies, when they first saw those, the NAIC acted on that and said, "Yep, you've got to include that in your metrics for how much capital you have to set aside for that liability."
Right.
And that gets adjusted based on mortality tables, interest rates, and whatnot. So, and there is an issue. You mentioned something about, they assume some people will not turn that rider on and it will
Correct.
lapse. So that's a whole nother discussion about lapse supported pricing. I don't know if that's really
But
appropriate
it's
here.
still
It's
part
just
of the
one of the
risk.
metrics.
Still part of the stress testing you're talking about. They're stress testing those income riders for X amount of percentage turn them on, et cetera, et cetera, et cetera.
Yeah.
I just find that part fascinating because just in the last 15 years have those income riders really become popular. I'm sure I'm in the range there, having just an old dude doing this.
Yep.
I mean, you're not old, you're young, but I'm old. And so, that's one of the things also I think people are going to look at, because state guarantee funds, getting back to that, do not cover income rider valuations. They cover accumulation values, correct?
Yeah, that's a topic that is being discussed right now. There's a difference between an annuitization of a lump sum
Uh-huh.
and then the ongoing, we'll keep paying you even if your lump sum is gone. So the way I understand and interpret it is that you've got $250,000 of protection, whether
Mm-hmm.
that's cash value or the present value of your annuity, guaranteed annuity payments.
Got it.
So that's again why I think if you're with a company that's of average strength and quality, that $250,000 number, it rings my bell personally. But if I thought things really were super ugly, I would lean towards personally having my money with a AAA rated 100 Comdex. And that's where we see. I mean, as you know, you get a call and someone says, Stan, I want a $1 million 5-year MIGA. You know where that's going most of the time.
Correct. Without
it's going to the
mentioning
biggest,
names.
baddest insurance company.
That's absolutely correct. Especially if they just want to do, I just want to do one carrier. You know, you're like, okay. What else? I had some other things. You speak while I'm thinking, John. Speak while I'm thinking.
No, I don't want to interrupt that. Not even for a second. I'm not concerned about the annuity industry, but I am concerned about the banks, and I am seeing people frozen over what's happening because they don't understand it with the banks. Do you, I mean, they have to, the banking industry has to look at the annuity industry and say, can we do something similar, or can we protect it better? Or is it always going to be like this free for all where, you know, every 7 to 10 years, we're going to have kind of these situations? Let me consult my spinner so that I'll be able to flip a coin.
I'm just trying to think logically. If I'm in the banking industry, you know, and because it sounds like to me, and you've been doing this for a long time, like I have, but you're on the smart side of it. You know, annuities and life insurance companies, because of the regulations, seems to be in this mode, this stress testing mode before the stress test is needed. Whereas now we're talking about, well, we need to stress test, and you're saying, well, annuities companies already do that because they have to.
And banks are stress testing too. I think there was just some reduction in the level of these systemically important banks, and you know they raised the limit before they had to do bigger stress tests. But insurance companies are definitely testing all the time. And remember, most insurance companies are owned by stakeholders and shareholders and stockholders. They are demanding this safety and the strength of this insurance company because it drives up the equity value of the securities. The company is on the ropes, you know, and I often look at this, how a certain company's stock is trading, whether a bank or an insurance company, to see, you know, just overall consumer confidence. And there are market analysts that are 100 times smarter than I am looking at these the cash flow metrics of the bank or the insurance company, saying, yeah, this is going to make it. And so yeah, there is definitely a lot of worrying going on in the financial services industry and the banking and the annuity industry to make sure that the institutions are strong and stay strong and exude confidence, because that's what it's about.
What do you work with a lot of large companies that have distribution networks for annuities? What are they telling you that they're hearing from the field and concerns from agents? Obviously, me and you communicate a lot, and I'm the unicorn agent out here that does things a little bit differently. But what's the typical local agent that sells 30 miles from their home saying? What are you hearing your contacts say?
Immediately before logging on with you, I was talking to a friend of mine who's here in Portland, Oregon, who walked in with a check for $250,000, which represented most of this woman's bank deposit. She had an account at a regional bank that was over 250, and she said, "I want a strong annuity company for this money and a 5-year rate." And banks and insurance companies and their CD rates are often pretty similar. And this person just believed that she'd be better off with some in the bank and some in an annuity with a strong company. So what everybody's hoping, Stan, is that there's not a contagion and that this thing doesn't get legs. And certainly there are people up late at night working on contingency plans to backstop the banking industry. I'm super happy when I read stuff in the press that big, smart, wealthy people are saying they have a high degree of confidence that the government's going to step in. And I mean, if we just watch what happened during COVID, oh my gosh, money was flowing everywhere from the government.
But we can't print it. By the way, I remember, because my brain is like a steel trap, as you know, John. Or is it like a fur trap?
I go with the steel trap, sure.
I go with the steel trap. There's some annuity companies that are being purchased by foreign entity companies, foreign owned companies. And there's been, I occasionally get the question because, my clients will go and do the research because, we're just not high pressure. We just give the information and have the conversation. And they'll come back and say, wait a minute, this company was purchased by X company that's not based here in the United States. Explain how that works, because the way I understand it and explain it in Southern English is that they might be from another place, but they got to act like us when they get here, right?
Maybe I should just
How's
shut
that?
up, let that set. But there's 4 or 5 really good examples where large Japanese insurance companies, mutual companies, I believe all or mostly, have purchased really good U.S. companies, including one right here in Portland, Oregon, one up in Seattle area, Midwest. And these companies were owned they were publicly traded companies, so I own shares of some of them. And now there is a large Japanese company owning it. And I had not a million calls, but a lot of calls. John, what do you think of this? Oh, I'm worried about this. I was thrilled. The Japanese culture and their financial sector is very, very long-term thinking.
Yes,
whereas Wall Street is quarter by quarter. And there was, I knew people that were in the insurance industry trying to prepare quarterly reports for shareholders and analysts. There's tremendous pressure.
Right.
A little less pressure when somebody's thinking about creating a 100-year plan for the company. That said, there was a large long-term care insurance company that had a buyout offer from a Chinese company. And there was a tremendous amount of resistance for that because the relationship between the United States and Japan is super friendly. And we're allies, and the US and China, there's obviously a little more tension there.
Sure.
So that did not happen, by the way. But so back to your statement, just because a Japanese owner, Daiichi or Sumitomo or Meiji Yasuda owns a life insurance company in the United States, that company's still domiciled here in Oregon. It has to meet all the Oregon metrics for risk-based capital, asset liability matching, all these safety nets we've been talking about. And only the normal profits of the insurance company are upstreamed to its parent instead of paid out to the shareholders. So I am not concerned about that.
So, and that's going to happen more and more. I think people just need to understand they're going to come over here and we're going to force them to speak financial English on how we do it. And the regulations are not going to change just because a foreign company comes and buys something here they then have to go and act just like other annuity companies.
Well, I think it's also worth mentioning that insurance didn't start here, right? I mean, Lloyd's of London, it might actually be in London, and the Europeans are big insurance buyers and huge reinsurance companies in Germany, Switzerland, France. I believe at one time AXA was the largest, and that's out of France, was the largest insurance holding company on the planet.
Yep.
The Europeans, I think, tremendous insurance people. Certainly the Japanese are, and I don't know much about Central America.
And if you don't believe that, you want a really good read, Moshe Milevsky's new book on tontines, however you want to pronounce it. He goes back and has lived in the gutter of the libraries in Europe, researching how life insurance and annuities were first introduced over there. So it's fascinating just how it all came about. Johnny Lenz, obviously you're one of my favorite people on the planet, and I don't have that many, but you're one of them. But as we always do at the podcast, is we do the mic drop moment. I count you down, 5, 4, 3, 2, 1, and then you are going to wow us with, you really are. You're going to wow us with something that the listener is going to say. Then I'm going to come back, comment on it, and close us out. But people wait all show for this, so no pressure whatsoever on that.
So just to make this clear, I'm supposed to come up with something new that I haven't already said.
And in a very succinct way that makes you look even better than you already do. You ready? And 5.
It's going to make me look even better than I already do?
Yeah. We're going to.
You got to give me a 10 count because this was not anticipated.
All right, because I'll give you a 10 count because I'll give the Southern version of it. I always say, you can't polish a turd, but you can roll it in glitter. Never forget that, John. Never forget that. That might be a song you hear down the road by some crazy band if they ever hear this podcast. All right, here we go. In 5, 4, 3, 2, 1, mic drop moment. The annuity architect himself, John Lenz, go.
Someday I'm going to stand on a stage and introduce someone who's with me on this podcast as one of the most famous innovators on the planet.
No.
And to a live audience in Vegas. That's what I'm going to do.
Oh my gosh, that's horrific. You're supposed to say something like, live life to the fullest because you could die tomorrow. You know, every breath you take should be a deep one and all of your thoughts should be deep as well. That's the kind of crap that I was looking for.
Then I will say that when I buy an annuity, I sleep really well at night. There's a million things on the planet that we can worry about all the time. But yeah, having a little bit of money in a safe spot is a good way to live. And I will introduce you as a special star someday.
And that is John Lenz.
Thanks,
one of my favorite people on the planet. Thank you so much for joining us on Fun with Annuities. And thank you every single person out there on all major podcast platforms and on the Fun with Annuities YouTube channel, where you now have verified that I have a face for radio. We'll see you next time.